You know what keeps me up at night? It is not the stock market crashing or missing out on the next Tesla. It is this nagging question that I bet you've thought about too. When everything goes sideways, when inflation keeps eating away at your paycheck, when governments keep printing money like it is going out of style, when your savings account becomes a slow motion wealth destruction machine, where do you actually put your money? I am Leo, and I've spent an embarrassing amount of time obsessing over this exact question. Not because I am some doomsday prepper stockpiling canned beans in my basement, but because I am a regular person who has watched the purchasing power of the dollar get absolutely demolished over the past few years. And if you are anything like me, you've probably found yourself staring at your portfolio at 2 a.m., wondering, should I be buying gold, silver, Bitcoin, all three, none of them? Today, we're going to cut through all the noise, all the hype, and all the apocalyptic fear-mongering to figure out what actually makes sense as a survival asset in 2025. And I am warning you right now, some of what I am about to tell you is going to challenge everything you think you know about money. Let me start with a story that'll put everything in perspective. In 1971, President Nixon did something that fundamentally changed the global financial system forever. He ended the Bretton Woods system and took the dollar off the gold standard. Now, if your eyes just glazed over at those words, stay with me, because this is the single most important thing to understand about modern money. Before 1971, the dollar was backed by gold. If you had a dollar, you could theoretically exchange it for a fixed amount of gold. This created a natural limit on how much money governments could print because they needed actual gold to back it up. But after Nixon severed that link, the dollar became what is called a fiat currency. Money that is valuable simply because the government says it is, not because it is backed by anything tangible. And what happened after that? The money printing started, and it never stopped. Over the past 50 years, the money supply has exploded. The purchasing power of the dollar has been cut by over 85%. Things that cost $1 in 1971 now cost you $7 or $8. Your grandparents could buy a house for $25,000. Now that same house costs $400,000. This isn't inflation in the traditional sense. This is systematic currency debasement. This is why people are scrambling to figure out where to park their wealth, because keeping it in dollars means watching it slowly evaporate. So let's talk about the three main alternatives that everyone's considering. Gold, silver, and Bitcoin. Gold has been money for literally thousands of years. Ancient civilizations used it. Empires rose and fell while gold maintained its value. There is something deeply embedded in human psychology that makes us value gold. It is scarce. It is durable. It doesn't corrode. It is divisible. And most importantly, no government can just print more of it. When I look at gold, here is what I see. It is the ultimate monetary bedrock. It has survived every single currency collapse in human history. The Roman denarius. Gone. The British pound, when it was the world reserve currency, devalued into oblivion. The Weimar Republic mark became worthless. But gold kept working. It is the financial cockroach. It survives everything. Central banks know this. That is why they've been buying gold at record rates over the past few years. China, Russia, India, they're all accumulating massive gold reserves. Why? Because they understand that in a world where fiat currencies are becoming increasingly unstable, gold is the ultimate insurance policy. But here is the thing about gold that nobody likes to talk about. It doesn't generate income. You can't stake it. It doesn't pay dividends. If you buy an ounce of gold today and hold it for 20 years, you'll still have 1 ounce of gold. Sure, its dollar price might have gone up dramatically, but that is not gold appreciating. That is the dollar depreciating. Gold is essentially a hedge against currency destruction, not a growth investment. And there is another issue with gold. It is heavy. It is hard to move. And it is difficult to transact with in the modern world. Try buying groceries with a gold coin. Try sending gold to someone across the country. It is not exactly practical for everyday use. Gold works great as stored value. But it is terrible as a medium of exchange in 2025. Now let's talk about silver. Silver is like gold's scrappier younger brother. It has many of the same properties. It has been used as money throughout history. It is scarce. It is durable. But silver has something gold doesn't: massive industrial demand. Silver is used in solar panels, electronics, medical devices, batteries. The world literally cannot function without silver in the modern age. This gives silver an interesting dual nature. It is both a monetary metal and an industrial commodity. During economic booms, industrial demand drives up the price. During economic busts, its monetary properties make it attractive as a safe haven. This means silver can potentially give you upside in multiple scenarios. There is also something called the gold-to-silver ratio that silver bugs love to talk about. Historically, this ratio has averaged around 15:1 to 20:1, meaning 1 ounce of gold was worth 15 to 20 ounces of silver. Silver advocates argue this means silver is massively undervalued relative to gold and has enormous upside potential. But here is the reality check on silver. It is even more impractical than gold for everyday transactions. It is bulkier, heavier per dollar of value, and harder to store. And while industrial demand is real, it also means silver prices can get hammered during economic downturns. When industrial production slows, silver is more volatile than gold, which can be great on the upside but painful on the downside. And then we have Bitcoin. Oh boy, Bitcoin. This is where things get really interesting and really controversial. I've been studying Bitcoin for years now, and I'm going to tell you something that might surprise you. Bitcoin might be the most important monetary innovation since the gold standard. Here is why. Bitcoin solves problems that gold and silver can't solve in the digital age. It is completely decentralized. No government or central bank controls it. The supply is absolutely fixed at 21 million coins forever. You can't print more Bitcoin. You can't inflate it. The scarcity is written into the code and guaranteed by mathematics and cryptography. And unlike gold or silver, Bitcoin is perfectly suited for the digital economy. You can send it anywhere in the world in minutes. You can verify its authenticity instantly. You can store billions of dollars worth on a hardware device, the size of a USB stick. Try doing that with gold bars. But here is where Bitcoin gets really fascinating from a monetary theory perspective. For something to function as money, it needs to serve 3 purposes: store of value, medium of exchange, and unit of account. Gold has been an excellent store of value, but a terrible medium of exchange in the modern world. Bitcoin is rapidly proving itself as a store of value. We've seen this over multiple market cycles now. And while it is not yet widely used as a medium of exchange or unit of account, the infrastructure is being built. The Lightning Network and other second-layer solutions are making Bitcoin transactions fast and cheap enough for everyday use. Countries like El Salvador have made it legal tender. Major companies are putting Bitcoin on their balance sheets. This isn't some fringe internet money anymore. This is a legitimate monetary network that is growing exponentially. Now, I can hear the skeptics already. Leo, Bitcoin is volatile. It crashed from $69,000 to $16,000. How can that be a store of value? And you know what? You are right to question that. Bitcoin's volatility is real, and it is a legitimate concern. But here is what I want you to understand. Bitcoin is still in its price discovery phase. It has only been around for 16 years. Gold has been around for thousands of years and has reached equilibrium pricing. Bitcoin is still being adopted, still being understood, still finding its place in the global financial system. The volatility is the price you pay for being early to potentially the most important monetary network of the 21st century. And when you zoom out and look at Bitcoin's performance over any 4-year period, it has outperformed literally every other asset class. Every single one. Yes, there are brutal drawdowns. Yes, it can drop 80% in a bear market, but it has always recovered and reached new all-time highs. Always the question is whether you believe this pattern will continue or whether this time is different. Here is something else most people don't understand about Bitcoin. It is the first asset in human history with true absolute scarcity. Gold is scarce, sure, but if the price goes high enough, more gold will be mined. There are asteroids in space containing trillions of dollars worth of gold. But Bitcoin 21 million coins, period. We already know exactly how many will ever exist. That has never been true for any monetary asset before. The other thing that blows my mind about Bitcoin is the network effect. Every additional user, every additional merchant, every additional country that adopts it makes the network more valuable and more resilient. This is similar to how the internet grew slowly at first, then exponentially. Bitcoin's adoption curve looks remarkably similar to the internet's adoption curve from the 1990s. But let's address the elephant in the room. Can Bitcoin actually become money in the truest sense? Can it replace fiat currencies? And this is where we need to get brutally honest about the challenges. First, governments hate competition for their monopoly on money. We've seen China ban Bitcoin. We've seen regulatory crackdowns in various countries. The US government is walking a tightrope between recognizing Bitcoin's legitimacy and trying to control it. If Bitcoin becomes too successful as an alternative to the dollar, you can bet there will be serious attempts to regulate it, control it, or even ban it. Second, the energy consumption argument is real. Bitcoin mining uses enormous amounts of electricity. Now, supporters argue that most of this comes from renewable sources, or would be wasted energy, and that the security benefits justify the cost. But it is still a genuine concern and a potential attack vector for critics. Third, user experience still isn't great for the average person. Seed phrases, hardware wallets, self-custody. It is all still too complicated for mainstream adoption. If your mom can't figure out how to use it safely, it is not ready for mass adoption yet, though this is improving rapidly. So where does all this leave us if you are a normal person trying to protect your wealth in an era of monetary insanity? What should you actually do? Here is my honest take. You probably need a combination of all three, weighted according to your specific situation and risk tolerance. This isn't a one-size-fits-all answer because everyone's circumstances are different. Gold should be your foundation, your monetary bedrock. This is the asset that has proven itself over thousands of years. If everything goes completely sideways, if there is a major financial crisis, if currencies collapse, gold will still be valuable. I'd suggest having at least 5 to 10% of your wealth in physical gold, not paper gold. Not gold ETFs, actual physical gold that you control, because in a real crisis, you want the metal, not a promise to deliver the metal. Silver is your speculative play within the precious metal space. If you believe in the industrial demand story and think the gold-silver ratio will revert to historical norms, silver offers more upside than gold, but it is also more volatile and harder to store. I'd keep this to maybe 5% of your portfolio maximum, and only if you have a strong conviction about it. Bitcoin is where things get interesting. If you are young and have a long time horizon, I think Bitcoin deserves serious consideration as a significant portion of your portfolio, maybe 10 to 25% depending on your risk tolerance. If you are older or more conservative, maybe 5 to 10%. The key is to understand that Bitcoin is volatile, so only invest what you can afford to see drop by 80% without panicking and selling at the bottom. But here is the critical thing that nobody talks about. The real wealth protection strategy isn't just about which assets you own. It is about having a diversified approach to preserving purchasing power. You want some gold for stability and crisis protection. You want some Bitcoin for upside and participation in the digital economy. You want some stocks for productive assets that generate earnings. You want some real estate for tangible value and cash flow. You want some cash for liquidity and OP opportunities. The worst thing you can do is go all in on any single asset class, convinced that it is the one true solution. The person who put everything into gold in 2011 at $1,900 an ounce and held through the decline to $1,100 in 2015 got destroyed. The person who bought Bitcoin at $69,000 in 2021 and sold at $16,000 in 2022 got wrecked. Diversification isn't just about spreading risk. It is about acknowledging that you don't know the future with certainty. Here is what I know for certain. The current monetary system is unsustainable. Governments around the world are drowning in debt they can never repay. The only way out is to inflate the currency and hope people don't notice their purchasing power evaporating. This has happened repeatedly throughout history, and it always ends the same way. The currency loses value, and people flee to harder forms of money. The question isn't whether this will happen. It is when and how severe it will be. And when it does happen, the people who position themselves in assets that can't be inflated away. Gold, silver, Bitcoin are going to be way better off than the people who kept everything in dollars or government bonds. But I also know this. Timing is impossible. I can't tell you whether the crisis hits next year or in 10 years. I can't tell you whether Bitcoin will hit $500,000 or drop to $10,000. First, I can't predict whether gold will surge to $5,000 an ounce or languish at $2,000 for another decade. Nobody can, and anyone who claims they can is lying to you or to themselves. So here is my actual advice. Start building positions in these assets now. Gradually, without trying to time the market perfectly. Dollar cost average into Bitcoin. Buy some physical gold when you have spare cash. Maybe pick up some silver if you believe in the story. Don't bet the farm on any single outcome. But don't ignore the warning signs either. And whatever you do, don't let fear or greed drive your decisions. I've seen people buy Bitcoin at the peak of a bubble because they were afraid of missing out. I've seen people sell all their gold right before a major run-up because they got impatient. I've seen people go all in on silver based on some apocalyptic YouTube video and then panic when it dropped 30%. The reality is that protecting your wealth in the current environment requires both conviction and patience. Conviction that the current system is broken and that hard assets will ultimately preserve purchasing power better than fiat currency. Patience to hold through the volatility, the corrections, the moments of doubt, and the periods where your assets underperform. One more thing I want to emphasize: physical possession matters, especially for gold and silver. If you don't hold it, you don't own it. Paper gold, ETFs, futures contracts. These are all fine for speculation, but they're not the same as having actual metal in your possession. In a real crisis, you want physical assets you control, not us from a financial institution that might not survive the crisis. For Bitcoin, the situation is different, but the principle is the same. Not your keys, not your coins. If your Bitcoin is sitting on an exchange, you don't really own it. The exchange does. Learn how to use a hardware wallet, understand seed phrases, and take self-custody. Seriously, yes, it is more complicated than leaving it on Coinbase. But it is also the only way to truly own your Bitcoin. Look, I am not going to sit here and tell you that gold, silver, or Bitcoin are guaranteed to make you rich. They're not get-rich-quick schemes. They're insurance policies against monetary debasement. They're ways to preserve purchasing power over long periods of time. They're hedges against the incompetence or malice of central bankers and politicians who have every incentive to inflate away the debt. The people who are going to come out ahead in the next decade aren't the ones who picked the single perfect asset and went all in. They're the ones who recognized the reality of monetary debasement, diversified into hard assets, and had the discipline to hold through the volatility. They're the ones who understood that protecting wealth is sometimes more important than growing wealth. So yes, gold, silver, and Bitcoin all deserve a place in your survival asset strategy. How much of each depends on your age, risk tolerance, time horizon, and conviction level. But the worst position you can be in is 100% fiat currency, hoping that the system that has been breaking down for 50 years will suddenly start working perfectly. Start small if you need to. Buy an ounce of silver, buy $100 worth of Bitcoin, get a small gold coin, just start, because the best time to build your survival asset position was 10 years ago. The second best time is today. If this helped clarify your thinking on gold, silver, and Bitcoin, hit that subscribe button. I break down money, investing, and wealth preservation every week because this stuff matters more than ever. Let's figure out how to protect what we've earned together. I am not a financial advisor, mortgage expert, or licensed financial professional. The content on this channel represents personal opinions only and is intended for educational and entertainment purposes. Please conduct your own research and seek professional guidance before making any major financial decisions. See you next time.